Hello, I'm Jonathan Moyes, Head of Investment Research at Wealth Club, and today I'm with Stuart Veal of Beringia to talk about the Proven VCTs. Hello Stuart, welcome to the studio. Firstly, could you give us some background to Beringia and your own experience?
Yeah, morning Jonathan. Beringia is a specialist venture capital fund manager, and we've managed the Proven VCTs since they were launched nearly 25 years ago. We also have an office in the States, and although that office isn't involved in managing the VCTs, we find it very helpful to have boots on the ground when helping our portfolio companies expand internationally. I'm the managing partner of Beringia, and I've been with the business for over 20 years now, and I also chair our investment committee.
And so turning to the VCTs, what do they aim to do for investors?
Well, the Proven VCTs aim to deliver a strong financial return to investors by investing in a portfolio of small and medium-sized companies with the potential for rapid growth in value.
And what sort of companies are you looking to back?
Well, we look to invest in companies which have already got significant revenues, which are well established in the market, and which we believe have got potential to grow significantly over the next few years.
Any particular sectors?
Well, we invest across a range of sectors, technology, healthcare, consumer, so we like to get a good portfolio spread.
And is there anything you avoid?
Well, we don't invest in pre-revenue startups because we think that they're too risky. And we also don't invest in companies with very high cash burn, where they're going to need significant amounts of additional funding following our initial investment.
So could you give us some recent examples of businesses you've backed within the VCTs?
Sure. I think one of the most exciting companies we've backed recently is a company called Dash Water. Dash is the leading UK brand of seltzer water, which is sparkling water which is lightly flavoured with natural fruit. And it's a new category in the UK. But in the US, seltzer water is a massive category with some very, very large players. And we believe that as the leading brand in the UK, Dash has got the potential to grow significantly as the UK market follows the US.
I think pretty much every trendy cafe I've been into recently has been selling Dash Water.
I'm glad to hear it.
It seems to be growing pretty quickly.
Good.
Any other examples?
Yes. From the technology side, we recently invested in a company called Gorilla, which provides a suite of cloud-based software tools for data processing, which allows companies in the energy industry to carry out complex forecasting and pricing tasks. This is an increasingly important area, and we've seen Gorilla grow significantly since we invested, with recurring revenue in November about 140% up on the same month last year.
So if we turn to the portfolios and we look at some of the more established holdings, any particular examples there that you're keen to highlight?
Yeah, I think one of the standout performers is a company called MPB. MPB operates a platform which allows people to buy and sell pre-owned photography and videography equipment online. MPB started from a small operation in Brighton, but it's expanded internationally and now has operations in the United States and in continental Europe, as well as a much enlarged operation here in the UK. And it's recently raised another round of funding at a significantly higher valuation than our last round of investment.
Any others? Luxury Promise, perhaps?
Yeah, Luxury Promise is also in that sort of circular economy space, this time in pre-owned luxury handbags, which amazingly can retail at up to £50,000. And again, it's a company which has grown incredibly quickly. And this area is a sort of speciality for Beringia. We previously had a great success with a company called Watchfinder, which was for buying and selling pre-owned luxury watches, a company that we made a 9 times return on our investment.
Any other examples?
Yes, another one will be Lucky Saint, which is the UK's leading no-alcohol beer company. The management of Lucky Saint have developed a really excellent product, which is far better than any of the other low-alcohol or no-alcohol beers in the market. And as a result, Lucky Saint is growing its distribution very, very quickly. In addition, the trend towards drinking less alcohol is gaining hold in the UK. It's much bigger in other continental countries, but it's really taking off in the UK. And we believe that that combination of superior product and growing market means that Lucky Saint is going to be one of our really successful investments.
So besides funding, what do you do to help these companies succeed?
Yeah, we work very closely with the companies that we invest in. We always put one of our experienced investment executives on the board of all the companies that we invest in. And they work very closely with the management teams on things like developing strategy, international expansion, building out the management team, and if appropriate, raising further rounds of funding. We also operate things like webinars, highly regarded webinars for the management team on topics like effective utilization of AI in your business or building a high-performing sales team.
And does your US office have any influence on some of these companies, or can it?
Yes, I mean, they operate different funds, so they do occasionally co-invest with our businesses, the VCT investments, but not very often. But as I mentioned, when we want to take portfolio companies into the States, which we frequently do, then having the US office there to help navigate the local environment is very useful.
So turning to the current environment, it's been pretty dreadful, I'd say, for most investors in the stock market recently. Is that affecting your underlying companies? Is it affecting the way you invest?
Well, I think one of the great things about investing in small companies is that if a business is able to identify a market need, which isn't currently being fulfilled, then it can still grow even if the overall economy is under pressure. And one of the other great things about the current environment for investors is that it allows us to get into companies at a much lower valuation than we have been able to do over recent years, which means that when we come to sell the business in a few years' time, we should be generating better returns for investors. And history has shown that the vintage years following an economic downturn have been the best for financial returns. But having said that, the current economic environment does create challenges for all businesses, and we try to protect our portfolio companies from those by making sure that they're well capitalized and that they have a clear pathway to positive cash flow generation so that they're able to resist any shocks that the market does throw at them.
But of course, it is risky investing in early stage startups. How risky is it investing in these VCTs? For every, say, 10 investments you make, how many do you expect not to make it?
Well, at the investment level, we try to minimise the risk by doing very detailed due diligence before we go into the companies to make sure that we identify all the risks and don't go ahead if we think that they're too great. At a portfolio level, the diversification with the spread over different sectors and companies really helps to protect investors in the fund from any adverse effects on one particular company. And we also don't invest at a very early stage. We only invest in companies which have proven themselves in the market. And so as a result of that, less than 10% of the companies that we invest in fail.
So turning to exits, you mentioned Watchfinder earlier as a good exit. Any recent exits you can talk about?
Yeah, we had a great exit earlier this year. We sold our investment in Monica Veneda, which is a luxury jewellery company. When we invested in Monica Veneda, it was a tiny business just selling its jewellery through department stores in the UK. But it's grown to the point where it has distribution in the US, in the Far East, the Middle East, and in Asia. And we sold our investment to a private equity company earlier this year, making a 13 times return on the cost of our investment.
So turning to the VCTs and their performance, how have they been performing recently?
Yeah, they've been performing well. Over 3 years, both of the funds are up around about 12%. And over a 10-year period, Proven's up over 40% and PGI around 30%.
So Stuart, what about dividends? What are you targeting, and are you confident you can continue to achieve this?
Well, the Proven VCTs have a target dividend yield of 5% of net asset value. We introduced that target about 10 years ago, and we've achieved it every year since then. And in addition, in some years, we've paid extra special dividends where we've had very significant and profitable exits. So that remains our target. Having said that, this is a target and not a commitment, and future dividends aren't guaranteed.
So to sum up, Stuart, for those that want to invest in a VCT this year, why should they invest in the Proven VCTs?
Well, the Proven VCTs are managed by a very experienced investment management team with a track record of success over many years. The portfolios are well diversified with investments in around 50 companies over various sectors. And some of the recent investments are performing particularly well, like Dash and Gorilla. And we believe that after a period of active investing, the VCTs are now poised to deliver excellent financial returns to investors.
Stuart Veal of Beringia, thank you very much.
Thank you.
If you're watching on YouTube, please press like and subscribe to the channel for more.